When most people hear the word crash, they picture one thing: digital boards glitching and a drop that wipes out portfolios before lunchtime. But the crash happening right now, as you watch this video, looks nothing like that. It is quiet, it is slow, and because it doesn't show up on a newsfeed, it is far more dangerous. Right now, retail investors are looking at this, the S&P 500. The index holds its ground, so the assumption is the water is fine. But that calm surface is hiding a widening disconnect between the major indices and the credit markets underneath. We are watching 3-decade-long macroeconomic tailwinds stop at the same time. For years, near-zero interest rates, frictionless global trade, and unchallenged U.S. fiscal dominance pushed every asset class higher. Now, those three forces are simultaneously reversing. Reversing these forces doesn't break the system on day one. The damage travels in delayed waves through the financial plumbing. The pressure builds in bank lending and bond yields long before it reaches the stock market. If you only rely on top-level indices to gauge risk, you will miss these warning signs until the damage to your portfolio is already done. The first wave hitting the system is a drain on liquidity. Think of market liquidity as the vital lubrication of the financial engine. It's the ease with which cash moves around. When it's abundant, companies can easily refinance their debts and keep asset prices elevated. Look at this chart tracking U.S. bank lending standards. Over the past year, banks have tightened their criteria for issuing loans at a rate rarely seen outside of a recession. Credit is drying up. You don't see this in the index because the tech giants pulling the S&P 500 upward, like Microsoft or Apple, sit on billions in cash. They don't need to visit a local bank to keep the lights on, so their stock prices hold perfectly steady. But just one layer deeper, small-cap businesses and regional banks are slamming into a wall. They rely on refinancing short-term debt, and right now, that capital is becoming either unavailable or prohibitively expensive. The surface-level view of the S&P 500 masks the internal strain on these smaller, credit-dependent businesses. The index looks healthy, even as the foundation underneath it begins to fracture. This leads to an illusion currently propping up the market. Analysts are still projecting corporate earnings growth based on the margins of an era where labor and capital were cheap. We have seen this disconnect before. In early 2000, tech stock earnings estimates were still positive, but the credit conditions that funded those internet startups had already started cracking months earlier. This timeline from 2000 shows the trap. Credit conditions collapsed first. Investors waiting for earnings confirmations lost up to 80% as the market fell. That same warning mechanism is flashing right now. The earnings revision ratio is hovering just above the historical correction threshold. Remember, the warning signal always precedes the damage. Reacting only after the damage becomes visible in an earnings report guarantees you will be the last one out the door. But the biggest risk isn't in the data. Human survival instincts evolved to react to sudden, highly visible threats, like a predator jumping out of the brush. We are biologically blind to slow, creeping deterioration. But a slow-moving macro deterioration that plays out over 6 to 12 months, your brain literally doesn't register it as a threat until it's too late. A 3% drop is followed by a 2% bounce. That recovery tricks the brain into a cycle of false hope and denial, convincing you the worst is over even as the macro conditions continue to decay. You hold on through months of this bleed until your portfolio is down 30%. At that point, the emotional pain becomes unbearable. The rational brain shuts off, and you sell at the exact moment the bottom is finally in. In a quiet crash, your own wiring is the enemy. The investors who survive are those who reposition based on the data before emotion takes over. Historically, every major market dislocation has been simultaneously the greatest wealth transfer opportunity. For those positioning early, this is a chance to move capital before the majority reacts. Here are the 5 moves the top 1% are executing right now. Move 1. Strategically raise your cash allocation to between 15 and 20%. You aren't doing this to hide. You're doing this to maintain optionality. When the forced selling comes, and it always comes, you want to be a buyer, not a seller. Move 2. Rotate into high-quality equities. This means dumping speculative growth and moving into companies with strong free cash flow and low debt, businesses that don't need credit to survive. Move 3. Watch the dollar and international rotation. The structural pressure on the US dollar is creating a historic setup for international and emerging market assets to outperform,
In environments like this, capital doesn't disappear, it rotates. Move 4. Hedge with a robust commodity layer. Hard assets thrive in high inflation environments. Hard assets and commodities have provided a crucial portfolio hedge. Oil, gold, agricultural commodities, they don't just survive inflationary dislocations, they thrive in them. Move 5. Capitalize on the credit cycle. As bank standards tighten, high-quality investment-grade bonds are offering the best risk-adjusted yields we have seen in over a decade. Navigating this requires timing. We break down the exact charts and the levels we're watching inside our free community, linked down in the description. A silent crash doesn't have to be a disaster. By moving capital based on the subterranean data rather than surface headlines, you can protect your wealth while the retail majority is still waiting for the news to turn red.